as far as financing goes in the US for Canadians, there's very limited options. You're looking at a 30% down payment.
Hmm.
The rates on a 30-year fixed with a 30-year amortization is 5.25%. On a 15-year fix, it's 4.75%. So that's 15-year amortization, 15-year fixed. The nice thing with the rate there is that it's guaranteed for that whole period. You can pay it off when you want. But the one other thing is that when you do finance down in the US, it comes with a higher cost. So you're looking at anywhere from a point to a point and a half of the purchase price for that purchase. So people who are buying properties less than $100,000, that's at the point where I say, is it really worth financing in the US?
Hmm.
And a lot of times it's not.
So so they should be getting the line of credit down here, something like what I would do.
Yeah, I think so. It's a much better option. It's less expensive. There's a lot less headaches. And then going in with cash, as I said before, is typically a much stronger way to go in as a buyer in the market right now.
Right. And you talked about the short sale, Mark. Now, you said that the owner still has control of the sale. Is there two different stages to that short sale? Does the bank ever get control, or is that strictly with the foreclosure that the bank has control?
Well, the bank has control. They're the ones in a foreclosure who are going to make the decision. Typically on a bank-owned property or a foreclosure, they're going to take as many bids in the period of 3-4 days that the listing is put up. Then a short sale. So I'm sorry, just to go back on a bank owner foreclosure, you're going to have many times multiple offers if it's a good property. Now the short sale is very different in that agents typically on a short sale will take the first offer that comes their way. So if a property hits the market today, Monday, we see the offer, we make the offer on Tuesday, close to what the market is bearing, or maybe slightly less.
Mm-hmm. What's
going to happen is the agent's going to take that offer to the seller or the owner of the property, have the signature done, and then that's where the process is such a
lengthy, drawn out one. I think
a laborious one, that can be frustrating for some folks as well, because we're waiting to see what's going to happen, where things are going to go with it. So the owner is the one signing the property, and then it's up to the agent to send all the paperwork off, the offer, those other things, that the seller must do to sell the property.
So on average, Mark, what's this short sale? What's the length of time? You talked about months. Like typically, what are you seeing? Like from the time I say, okay, Mark, I like this property, let's put in an offer. Is it a time of up to 4 months before it's even accepted, or how does that work?
Well, to give you an idea, we have a client who we've been working with. He's probably put about 19 to 20 offers on properties in the last 3 months, and we've got 2.
And those were all short sales?
We've got about a 10%. Not all short sales. There's probably about half of those have been short sales. So of the 10, 2 actually converted within a 3-month period. So it's hard for me to say, it's going to take a month, it's going to take 2 months, it's going to take 3 months. In the 3 months, we've got 2 out of 10.
Right.
So, 20, 25%. They continue to say it's getting better, the process is getting better. Sometimes when clients will see properties, they'll say short sale approved or already approved by the bank, which is usually a good sign, means that the bank's willing to accept that price on that given property. So, we'll say to somebody, okay, the bank is willing to take $45,000 on this 2-bed, 2-bath condo, not 44. You have to come in at 45.
Mm-hmm. So would you say that's the risk for a Canadian is no greater than an American buying in the U.S. in terms of just owning a property outside of the country?
No, there's no greater risk to a Canadian, especially in the western states where we deal. There's no additional property taxes like there are in Florida. Or obviously, Texas has very high property taxes there. But a Canadian owning a property in Phoenix or Vegas, where we service, is not looking at paying more taxes than, say, an American citizen will. The big difference for a Canadian versus an American is that an American can do what's called a 1031 exchange. So if they have growth, if they bought a property, and it doubled in value in the span of 3 years, they could sell that property and then move it to another property without paying capital gains. A Canadian can't do that. When they eventually sell the property, they're going to pay capital gains on the property irregardless.
In U.S. and Canada, or how does that work?
No, in the U.S., they're going to pay their capital gains, which right now is about 15%.
Yeah.
And then any of the tax payable in the U.S. will be attributable to their CCRA, their Canadian tax return. They'll pay the difference. So someone in a 30% tax bracket will end up paying the difference. So they'll pay 15% in the U.S. and then an additional 15% in Canada.
Okay. And that's regardless of whether they're living in it, renting it out, doesn't matter.
Correct.
Okay.
Correct. Difference if someone's going to buy an investment property versus a second home is that if they're going to earn an income on that property, they're going to need to get a tax ID number. And that's something we help our clients out with. So,
and is it fairly easy to get?
It is, yeah. Typically what we'll do is the year after an individual earns income, so someone buys a property this year in 2010, if they own it for half a year, then they're going to file their tax return for that half year at the end of, in early 2011 and obtain their tax ID number typically at the same time.
Mm-hmm.
They'll have to file what's called a 1040 NR, which is a non-resident tax return, and pay tax on any of the income that they earn. And of course, it's very similar to Canada. They're going to be able, as I mentioned earlier, to deduct the interest on their line of credit if they use funds from their line of credit.
Right.
Any of the HOA fees, taxes, and any other expenses that they may have. So they'll be able to do all those things. The biggest difference for a Canadian, again, as I mentioned before, is the 1031 exchange. And the other one is in Canada, we have capital cost allowance that we can or cannot take on a property. In the US, someone would have to depreciate their property. Okay, so they'll have to depreciate their property over a period of 27 and a half years. To give you an idea of how that works is, so say somebody bought a property for $81,000, just for a easy sort of number to use. They'll have to depreciate their property by $3,000 approximately each year against any of the income. So a classic case, somebody earns $10,000 a year in income. They have $5,000 in interest, a couple $1,000s in taxes and HOA fees, and then that additional $3,000 in depreciation will basically take them to a sum zero. So they literally have no income tax to pay because of all of those different expenses. How that affects them down the road when they sell it is if someone had depreciated that property over a period of 10 years by $3,000 per year, they would have to reduce the adjusted cost base of their property by $30,000 or $3,000 times the 10 years that they depreciated the property. So that's really the two distinct differences for a Canadian. A, they would have to file a non-resident tax return, and B, depreciate the property. If they own it as a second home, nothing. All they're going to have to pay is that capital gains tax at the end of the day.
So the second part you talked about is only if they're going to buy it as a rental property or an investment property.
Only as an investment property. So,
right.
I give you some of those examples. It really is quite simple. I think some Canadians who go into this venture are thinking, oh, it's an overwhelming process. I'm buying in the States. It's very foreign. It's really not. It's very simple. I mean, each year you probably spend, $300-$400 on filing tax returns, and that's about it. So you give the accountant your expenses, you file your tax return in the U.S., and then any losses or gains that you earned in the U.S. go back to your Canadian tax return. That's it.
That's it. And that's something that you're going to obviously go over with the client when they're, working with you on your website.
Absolutely.